Welcome. We are going to be talking, my clicker doesn't work, so I'm going to be real close to my computer, analyzing different investment types. I didn't workshop that name very well. It's not a very good name. We're going to be talking about different types of investments, though. We're going to do mainly focus on fix and flips, buy and holds, a couple different strategies, and how to analyze buy and holds, and then multifamily and commercial properties, because they're all just a little bit different. How you analyze them, how people look, how buyers look at them, and how an agent should present them to a client. So if you're here because you want to invest yourself, we'll talk about how to analyze that. Or if you're here because you want to just sound educated as you talk to investor clients, we'll help you talk about that as well. Okay. Topics we're going to be going through: how to fix, or how to find investment deals, different ways to find them. We're not going to get too in depth there, but we're going to talk about different ways to do that. We're going to talk about analyzing and presenting fix and flips, analyzing and presenting buy and hold properties, and then multifamily and commercial, how to analyze and present multifamily and commercial properties. All right, so first section, finding deals. There's a million ways to find real estate transactions. The first several investment properties that I got into when I was early in my investing career were just kind of client deals that fell in my lap. Agents would bring them to me that found a deal, and I'd look at it and be like, that's a good deal, I'll take it. Or I went and shown a FSBO and it was a good deal, and so I took it. So if you're in the market and you have your eyes peeled and kind of know what to look for, know how to analyze, you'll just kind of find them. Some will pop into you. Maybe you're not in a position where you can financially take it down, maybe with your banking relationships or just financially down payment, renovation wise. But if you know how to identify them, money is never the problem. I promise you there is enough money in this city to take on every single investment property that you could ever find, if you can find the deal. The deal, like I say down here, the math is simple, the transaction, the renovation, everything's simple. The hard part is finding the deal. That's why wholesalers even exist, because there's tons of money on the sidelines and money wanting to be invested, but they don't want to pound the pavement, make the phone calls, do all the analysis, have all the follow-up and the conversation. They just want a deal so they can take it down, buy it, hold it, flip it, do whatever. So the math, the money, all that's simple. If you can find the deal, that is going to be the hard part. So a couple ways to find them. Wholesalers. Get on, I tell everyone the same thing. Go out to Oklahoma City Investors Facebook group and say, I'm looking to buy some investment properties. Please add me to your email list. Or when people write, I have a property to sell or whatever, comment on, please add me to your email list. So the more you engage with wholesalers, get on all their email lists. Like Chris, how many email lists are you on? Do you know? Yeah, I'm probably on 40 or 50. Some of them I recognize, I don't even read them because I know they're junk. And some of them I look at and take seriously. So the more you're on, the more shots on goal you're going to get, the more opportunities. Because when you're brand new, what you need to do more than anything is just, again, shots on goal. You need to analyze properties. You're not going to know if you run across a good one until you've analyzed 15 bad ones. Does that make sense? So when you're brand new, starting out, looking at getting into working with clients, and we'll talk about this more, or looking at your own properties, you just have to analyze 20, 30, 40, 50, 100 of them. And then when you do it, when the unicorn pops out, you'll recognize it right away and you'll be able to jump on it. But if you've never analyzed any, you don't know if one's good or bad. You don't know if this return or this cash flow or this price or this ARV or whatever is good until you've looked at a lot of them. So getting hooked up with wholesalers, getting on their email lists, joining all the investor Facebook pages. There's 10 or 15 of them probably out there. Just kind of getting involved, and that's how you're going to find some. Other investors. I saw this stat, and I don't remember it exactly, so I'm going to tell you what I remember it to be. 80% of landlords own less than 5 properties. So the vast majority of landlords out there are just mom and pop investors. It's maybe the first home they ever bought and they kept it as a rental, or maybe mom or grandma passed away and I kept that house as a rental, something like that. The vast majority of landlords are not the REI nations that own, how many do they own total?
Thousands.
Yeah, probably tens, maybe not tens of that, thousands across.
Say that we can make it like 5,000.
Okay, so 5,000 across the Midwest. Just, yeah. So the vast majority of investment properties are not that. They're not some rich billionaire sitting somewhere, and it's someone who owns 1, 2, 3, or 4 or 5, and they're every 12 months when that lease comes up, they're tired of dealing with it. So talking to other investors, if you see an investor listing a house, always ask them what else they have. because they're almost always selling. If they're selling one, they're almost always selling others. So other investors is a great way to find them. I did a deal with a guy 2 years ago. He's an investor out of California. I sold him one of my properties, and I'm on his list. Every 3 months, he sends me a text message. You got anything you're trying to sell? So other investors are a great way to find deals. What they call tired landlords. You know, most people, if you're new and getting into real estate investing, you're like, why are they selling it? What's wrong with it? The reality is some people just get freaking tired of owning real estate properties. Specific properties too. Properties that are paying. I've sold a house that cost me so much money. Every month something's breaking. It's the worst thing I've ever owned. I sell it, and I know the guy who ended up buying it. I told him all about it. Never had an issue. It's been occupied for like 3 years. Nothing's just some properties suck for you, and they're great. I didn't. I didn't. They just stopped breaking. So it's never like, what's the catch or why are you selling? Some people are just done being real estate investors. Strategies change, financial situations change. People hit retirement age. People retire and start buying. There's a million reasons why investors sell. So wholesalers, investors, for sale by owners. This is just another opportunity for you to kind of go direct to seller. When you go to direct to seller, you can learn a lot more about the transaction, a lot more about the seller, a lot more about the financial issues or hardship if there is any. So you can kind of have direct conversations with the seller and get into. I got my real estate my license almost 12 years ago now originally because I was a for sale by owner, and I got 2 or 3 texts a week saying, cash offer of this amount, and they're all terrible offers, but people go after FSBOs because they sell. They think if I can just save this 6% commission but sell it 20% under market, I'm good, but they don't know what's going on. So FRBOs, for rent by owners, again, vast majority of landlords are mom and pop landlords. So you're going to see a lot of those Lowe's for rent signs out front of houses. Those people, again, they probably don't own 100 properties. They probably own 1, 2, 3, 4, or 5. So reaching out to them when the property, they just spent $1,000 to $5,000 doing a make ready. They just made a mortgage payment because no one's living in it and paying for the mortgage, right? So they're out. This is the prime time where the pain is at the highest, where you can say, hey, why don't you just sell that? Why do you get rid of it? How much equity do you have? Oh my gosh, you have that much equity? They are right where they need to be interested in selling real estate. So for rent by owners, don't ever call a property management company because they're going to tell you to buzz off. But for rent by owners, you're going to have luck. Expired listings, same thing as FSBOs. You're direct to seller. They just tried to sell it and they couldn't, so maybe they'd be more interested in a discounted offer, a cash offer, that kind of thing. So another opportunity at going direct to seller and finding potential hardship or potential pain where you can solve a problem for them. Beyond this is kind of the real estate agent way to find deals. If you are wanting to go find your own deals, when you find deals through here, they're typically not at the deep discount that you might need or want them at nowadays. The best way to find the best real estate transactions is doing direct to seller marketing, where you are the one negotiating with the seller because there's no middleman, there's no one else that needs to take a rip off the commission or off the equity. That's where the juiciest deals are going to be. And the problem is you got to spend $1,000 to $5,000-$10,000 a month on mailers, bandit signs, doing stuff like that. So when you see those We Buy Ugly Houses or anything like that, that is an attempt for an investor to go direct to seller to find distressed properties or distressed situations, to find deeply discounted deals. So if I buy it through a wholesaler, it's probably because they went direct to seller. They're going to rip 5, 10, 15 grand off and then give me what's left. And then I'm going to go do all the actual hard work. So wholesaling, going direct to seller is always the best way. There's a bunch of ways to do that. But going direct to seller, making cold calls is going to be the cheapest, easiest way. We have RedX at Copper Creek. Circle a property or circle a neighborhood that you want to invest in, and just start making phone calls. Have you ever thought about selling? You ever thought about selling? That kind of. We have a couple scripts, but that's the basic gist. Questions on this slide? There's kind of a lot to this. I only touched a small percentage of how to find deals, but that's not what we're focusing on today. Questions on finding deals, different opportunities? Again, remember, the math is simple. I'm going to go through this math and you're going to laugh. This is very much second grade math. The hard part is finding the deal, getting good connections, that kind of thing.
Brett, I got one. With wholesalers, like you mentioned that you're on a bunch of lists and you
you know that many of them are crap.
Yeah.
Like, how do you, like a lot of what they'll do is they'll say, you know, it needs this much in it. Some of them might give a ballpark of what that rehab would be, and then many of them will give a ballpark ARV. How do you, I mean, you're going to analyze the deal, but how do you know, like, are they generally accurate, or many of them aren't?
No. So, no. Yeah. If an investor gives me an ARV, or if a wholesaler or anyone gives me an ARV, you're a seller, right, for that matter. If I go direct to a FSBO or something, if anyone gives me an ARV or a rehab budget, pretend they didn't even give it to you. Literally ignore it, because what they're doing, or not what they're doing on purpose, but it creates a price anchor in your head. And you might fudge numbers a little bit to get closer to that price, even though it's not good for you. So literally ignore it and do your own analysis on everything. Yeah, good question. They don't know. Well, they're trying to sell it. They're trying to make money. So they're going to give you an ARV. The number one thing I see when we're looking at deals, and we'll talk more about it in a second, is people trying to apply a price per square foot to a house that is significantly larger than every single comp that they give you. So they're going to say, this house can go for $350,000. And it's like, oh, I looked at it and it's, $180 a foot. Oh, yeah, he's right. $180 a foot's a reasonable price. Every other comp is 1,200 feet. Your comp is 2,500 feet. It's like, well, no. So you're selling a $350,000 house in a $170,000 neighborhood. And then that's how investors get in trouble, is they don't know how to do their own analysis, and they take the wholesaler or another investor's word for it, and now they're left with a property that's overpriced, or they put too much money in. So good question. Completely ignore whatever they tell you. Do your own analysis. Again, math is simple. Finding the money is simple. You find the deal. That is the hard part. You find the deal. There will be people who will do, partner with you on it, or connect you and buy it from you. Easy stuff once you find the deal. All right, we're going to talk about fix and flip properties first. Super simple, but there's a couple things in here a lot of people miss a lot, and it's what causes people to lose money or not make money, as much money as they want. So this is the math right here. After repair value, I'm going to subtract out my renovation cost. I'm going to subtract out my quiet costs. I'm going to subtract out my desired profit, and I'm going to be left with how much money I can offer on this property. That's the math right there. So ARV, after repair value. This is the price. This is how much the home is worth after I put this much money in it. Now these two are together. You can't do an ARV of top market, but only do middle of the market repairs, right? So you have to make sure, if I'm comping houses that have granite, my house better put granite in it, right? If I'm comping houses that have 2-car garage, I can't convert that garage, right? So your renovations and your ARV have to be together, side by side. But this is the math. So ARV is going to be what the home is worth after all repairs. Renovation is how much it will cost to bring that condition to top of market. It's important. Your renovation has to match your value. Quiet costs are going to be your buying, holding, and selling costs. This is the number one thing people don't calculate. They think it could sell for this, I put this in it, and I bought it for this, and there's my number. And they forget about the holding costs, the buying costs, and the selling costs of real estate, which is a huge line item you'll see here in a second. Then my desired profit, how much do I need to make this worth my time? I'll talk about that more in a second too. And then the maximum offer. This is the highest price I can pay for the property. So if you click on this YouTube video, I'm going to email this out to everyone. You click on this YouTube video, it's a 7 or 8 minute video of me kind of breaking down what I'm about to tell you, but in a video format. So it's good. It's good stuff. So very important. Write this down if you're taking notes. Start from the top and work down. So many people, to your point, they start from the list price and they work up. And that's how you lose money. You start to fudge numbers. You think, it's listed at 200. If I can probably do the remodel for 40 instead of 45, and I could probably push it to 250 instead of 240,000. I could probably push, and then you end up fudging numbers everywhere you go to try to appease a list price, and then you break even or lose money. So start from the top. This is the number one thing. You buy it right by having this number correct and this number correct. So start from the top and work down. Never start from the list price and work up. Always start from your ARV and work down. So here's an example. After repair value, so we're just going to say this home we're looking at that I made up last night while I was doing this is $275,000 ARV. Never use the highest comp. If 275 is like 200 a foot or something, or 150 a foot, and there's only one comp that's ever sold for 150 a foot or nothing, but you just think you can make this one nicer because it's cooler, a better location, never, never, never do that. You don't want to be the highest comp. That's how you get stuck with a house on the market. You have to drop prices, and then you're stuck. Your profit gets eaten up like that. So never be the highest comp on the market. Very important when you're doing ARV. Renovations. General rule of thumb to get you in the ballpark. While you're doing an analysis, we can do $20 per foot. There's so many caveats with this. I want to make sure I list them all. So, general rule of thumb. $20 a foot if it's a cosmetic flip, paint, flooring, fixtures, stuff like that. Cosmetic, I'm coming in, couple week job, $20 a foot to do the whole house. $45 a foot if you're having to do some of the major systems. Maybe if you're putting roof on, replacing a condenser, have to update some electrical, stuff like that. And then beyond that, if you're doing like high-end luxury flips, these rules are out the window. Completely different. These also only work if you're flipping or buying houses really over about 1,200 square feet. Under that, these rules are going to be too small. And it's because a kitchen, think of it, a kitchen is going to cost what a kitchen costs, give or take 15%. The cabinets, the flooring, the fixtures, the sink, the fridge, all that stuff is going to cost 7 to 10 grand, 15 grand, regardless if it's a 2,000 square foot house or a 1,000 square foot house. So if you're applying $45 a foot to 1,000 square foot, it's not going to give you enough money. Does that make sense? Same with the bathroom. Bathrooms cost about the same. There's a tub, a toilet, and a sink, right? They all about cost the same. So a bathroom is going to be 4 to 6 grand in a 1,000 square foot house, or 4 to 6 grand in a 2,500 square foot house. So that's why if you get too small, you cut yourself short. You don't give yourself enough money. So again, general rule of thumb. This is so that you can analyze it to say, okay, I came up with this, bam, okay, we're close. Now, then you jump into getting a contractor and actually working through the real numbers. But this does the analysis for you up front to know if you're even in the ballpark. So general, high level rule of thumb. I can't say rule of thumb. I'm going to say it one more time. General rule of thumb. Don't buy a house just based on this number that Brett gave you one time. Get a contractor. If you've not done a bunch of properties, get someone else who has. It's a general rule of thumb. I use this for my own math when I'm looking at it initially. Okay. Have I beat that horse? Okay. Quiet costs. So this is your cost to buy, your cost to hold, and the biggest one, your cost to sell. Everyone in this room is a real estate agent. We know there's 3 to 5% of commission that's going to be taken at the end. It's a big chunk. The higher the price goes, the more that quiet cost gets. People always forget about TRRs when they flip houses too. When people buy stuff, inspector's going to comb through it, and they already don't like you because you're profiting on this house. So they're going to look in flippers or cut corners, and they're blah blah blah, right? So they're already looking for stuff. You're going to find stuff in the house because no house is perfect. So TRR is important. Your actual title and commission closing costs, your holding cost, your insurance, your utilities, all that kind of stuff that it just costs money to own a home. The taxes while you're holding it is going to be in there, and then your buying costs, which is going to be your bank fees, your title fees from when you acquire the property. So you can see 17.5, if I didn't calculate that in, and all I did was ARV minus repairs minus my profit, half the profit, a third of the profit goes away if I don't calculate that in. And that's if I'm lucky. And that's if nothing goes wrong. And then desired profit. So it says here, this is a cushion, not just profit. Number one thing I see new people say all the time, I don't need 30 grand. I'd be fine if I flipped a house and made 8 grand. Guess what? Houses have things wrong with them. If you factor 8 grand, you're going to end up with 0 or negative 8 grand. So this is a cushion and a profit. If you do a phenomenal job inspecting the property, contractors, and a freaking polar vortex doesn't come through town and bust a pipe while you're, all kinds of crap that happens, right? If you do a phenomenal job, then this is what you can expect. But it never goes perfect. It just won't ever. They're going to tear out a wall and find something wrong. They're going to pull up a floor and find something. It's never perfect. So this is not just profit, it is cushion as well. Again, number one thing I always see is people are like, I'll just flip a house and make 10 grand. Oh, 10 grand's awesome. I'd love to have 10 grand. 10 grand can get eaten up in one TRR item. One item. Gone. Then your maximum offer. Do not exceed. So start from the top and work down. So what you'll see, oh man, the problem with this is, this looks so simple and easy, right? The problem is you'll do this analysis and the list price is what? 210, right? It's like, God, that's not a deal. I'll do another one. The list price is 190. Well, that's not a deal. I'll do another one. The list price is 170. Okay, we're in the ballpark. So now I'm going to offer 157, and we're going to try to end up at our max price. But the more that's the idea, is you got to do 100 of these, and you'll see that the margin is way off all the time. And then you'll find when the margin's close, you make an offer. Or the other thing is just the spray and pray method, where it's just like, I don't care if it's listed at 250 or 150, I'm making an offer at this price over and over and over and over on every house on the MLS. REI is really good at that, just shooting out 50 offers a week, and 10% of them accept it. So, but that's the problem. Math is simple. The problem is the deal doesn't always have that much meat on the bone, because that 30 grand, someone else, the homeowner wants that, or a wholesaler wants that, or whatever. So that's the problem, is you're going to find these deals where they're listed at 180, 190, 200. And so what I'll tell you, kind of to the first question is, do I trust their ARV, or do I trust their remodel cost? The answer is no, because they're going to fudge the ARV, they're going to undercut their repairs, and then they're going to have it listed at like 180. Well, most wholesalers and most sellers in general they have their own 30 grand built into it, even if they're a wholesaler. So make the offer. Just put it out there. And some will say no, some will say hell no, and some will say sure. So that's the problem, is you're never going to find this property and it's listed at 162. It just doesn't exist. It's always going to be listed higher. You got to negotiate. You got to go find the deal. Again, YouTube video where I talk a little bit more detail about that, and I kind of break all the math down again. Okay, so analyzing, I think this is supposed to be presenting. It's supposed to say presenting a fix and flip property. So when you're, as a real estate agent, or as you're doing your own initial analysis yourself, the more you analyze, the better you'll get at analyzing. And then the only way to get really good at this is just to do a bunch. You're going to learn way more when you flip your first property than analyzing 100. But the more detail you put into the analyzing process, Analyze. Thank you, Eleanor. The analyzing process, the more you're going to catch things, and the more accurate all your stuff's going to be. So I created a while back an analysis packet. It's going to have the property summary, which is this document. Again, these links take you to a PDF version, and let me open the PDF version. Anything happen? Here we go. That's not the whole thing, is it? I put it back here for some reason. There we are. Yes, all the links will be in here, yeah. The links will all work for you. So this is the analysis packet. At a high level, it is the property summary, which is this document. We'll go over it. It's the county assessor page for just different data about the home, year built, size, that kind of stuff. Map of comparable properties. This is important. I'll show you why. And then comparable properties MLS sheets, so you can see more data on the actual comps. So if someone, because again, as an investor, I don't know how I keep messing this up. As an investor, people send me properties all the time, and then I got to go do all this homework. To a point where sometimes someone will send me something and I'm just busy and I just won't do it. I could have lost out on a deal. They could have lost out on a deal. So if you're the investor, or if you're a realtor trying to make money, or a wholesaler trying to make money, do this. Good wholesalers send out investor packets with it. They have the comps, they have the sheets and all that stuff. So if you're a real estate agent working with an investor, do this for them. It's not hard. You stand to make $3,000 to $10,000. Do it. It's not hard. Okay. Packet. Okay, so this is the investor summary page. Essentially, it's going to break down all the details. It has that formula I gave you, ARV. Can't zoom in any further than that. So it has the ARV minus the improvement cost, minus the quiet cost, minus my profit, my maximum offer. Has the comps here, has the square foots, prices, and the price per square foot. It does my math up here for me. Improvement costs, so this is kitchen countertops, flooring, paint, interior, exterior, bathroom remodel, basic $20,000. So that goes up here and then goes up here. Quiet costs, buying costs of $3,000, holding costs of $2,000, selling costs of $12,000, $17,500 goes up here. And then my minimum profit, $25,000, goes up here. So it creates my maximum offer of $118,000. So the spreadsheet that I sent you has a lot of this locked, and it has yellow pages or yellow cells where you input the data. So it kind of shows you how to use it. But this is the basic idea. So it's going to make you do the work of finding the comps, putting them out here. It's going to make you do the work of outlining what the costs are associated, and then your quiet. Make sure you factor in your quiet costs. Then it has assessor page, basic stuff. This is the subject property assessor page, and then it's got a multi-map and property list view. So if you ever go into the MLS, select properties, and click print, it gives you an option of different ways to view the properties that you're trying to print. One of them is called a multi-line map. So it's going to list out the properties and where they're at. So if someone sends me this and I see one comp in the same neighborhood and then the other 4 comps are across a main street in a different neighborhood, I know they're crap comps and they're not good or whatever, right? So this does a bunch of things for them. Or if I see these 3 comps all right next door and they're really good, okay, at a glance I can look at it really quick and see if they're good comps or bad comps. Same with square footage. This one's 912 square feet. You should probably throw that one out immediately. It's, we're 1,400 square feet on the. This is 1,350. So I probably wouldn't use the 912 foot, but someone did. It was me. I did this, but I wouldn't anymore. This was back in 2019. I've grown so much since then. And then right, and then all the comps. So it shows the MLS sheet of the comps. You can see the exterior. You can see any, again, refinished hardwood floors. It shows you just details on the property. So an investor can look at this and see, okay, this might be in my ballpark. This might work out. And then they can start to do their own analysis. But if they have to spend 20, 30 minutes even deciding if it's something that they should dig into more, it's just less likely they're gonna move down that path. This is the investor packet. All makes sense. Any questions on this? Super simple to put together. Maybe 20, 30 minutes of work, maybe. If you're really good at the MLS, you can kind of go through it quicker. Yeah.
Is there a minimum like your minimum profit you shoot for, like a percentage wise, or enough to cover the cushion, or
no? That completely depends. I mean, that depends on so many things. Yeah, like how many you're doing, how long you think it'll take, what the risk is on the top. Like I put 30 grand. If I was flipping a $700,000 house, 30 grand ain't gonna cut it, right? One price drop and that eats up 30 grand. So I've not found like a percentage. I just kind of
depends on the property.
Maybe 10%. I mean, you could say maybe 10% on as you scale over 300,000, maybe. If I'm flipping a $400,000 house, maybe 30 to 40 grand. If I'm flipping a $500,000, maybe 8 to 10%. I'm just kind of shooting from the hip. Yeah.
So are you actually going to look at these properties before you do all this to see the level of reno or no? So
if you have photos, it's better, and you can normally take a look. Before I make an offer, I like to walk through it because photos are, we all know how photos are. So I'd like to, but sometimes investments don't let you. Or if you're buying a sheriff sale or something, you can't get in. So this will get you in the ballpark. And again, the more you do, I've not done so many investment deals where I can just know without but I've gone through enough houses as a real estate agent. I've done enough inspections and TRRs and done enough flips and rentals that I can look at a house and say, this house probably has a bad sewer line. This one has a Federal Pacific panel in it. This one has, just stuff. I can kind of assume what we're going to get into just because I've been in thousands of houses in a very analytical manner for the past 12 years. So I'd like to go in it because I'm about to spend a bunch of money, but I can get real close without it. And you want to cushion. That's why you want to start here and work down. Not, this is where you can hurt yourself by saying, there's probably not going to be any overages, so we'll cut the contingency out. We're probably not going to have to replace any electrical, so we'll just take that off the line item. And then you get stuck trying to meet someone's price, and you get stuck when that stuff happens, and that's how you lose money.
Do this for a seller. has a crap property.
Yeah,
Where
this is
you're
what
gonna
investors
go
are going to
and
look
help
at.
them list it, and then you can show them this and tell them why they can't ask
Yeah.
20 for the house because it's going to cost somebody all that.
Yeah, and I mean that's a great point. It's like I work with enough sellers. I know this is what they're going to. This is the math they're going to do. So if we listed it 180, maybe a homeowner comes in that doesn't need 30 grand. You know, someone that wants to do their own work. But anyone who spends money and takes risk on a remodel wants some sort of sweat equity, right? So they're gonna have to build that equity. You know, we call it profit, but a homeowner will call it equity. You know, these are the numbers, right? This is what it's going to cost them to buy, cost them to hold, cost them to. So, yeah, not a bad. If you're trying to get a seller down to a spot, yeah. Mm-hmm.
The comps you select, are they? Do they go back, say, the last 6 months, or is there?
Yeah. So when you're flipping a house, again, it depends. When you're comping a house, I don't like to go past 6 months. So if I'm looking at a house for comps and I'm going to flip, and I know it's going to take me 3 months to flip it, I really don't want to pull a comp from 6 months ago because now it's 9 months old when it hits the market, 9 or 10 months old. So if I'm looking at a house I'm going to flip, I like to keep them 90 days if I can. Now if I can't, and I know the neighborhood, and I know that comp's pretty comparable, and I know generally have my finger on the pulse, but that's risky. Anytime you're going with your gut instead of data, it's risky. That's how people lose money. So I like comps to be 90 days or newer, because by the time the remodel's done, those comps will be 60 days old. Good question. 2019, Brett might not have, he probably went back 6 months. He didn't know what he was doing. Okay, so property summary. You can download these, practice it. When the whole reason I got my license was to keep working at my job and just flip properties on the side. Whole reason I did it. So every deal I saw pop up, I was analyzing. I analyzed hundreds of deals before I ever bought my first one. So it's good practice to just go analyze them, whether you have the money or you're going to buy it or not. Okay, questions on a flip. That's the last slide on the flip. Questions on flip properties, construction, holding, buying, all that stuff.
For your contract, like you've got your rough idea of these numbers. Are you going under contract before that you're walking it with your contractor to firm up your reno?
Depends on the property. Wholesalers, I always try to get in the door. Most of the time they can let you in the door sometimes. If it's on the MLS, I always try to get in the door. So I would prefer get in. If I don't get in, I'm probably going to have a line item on my budget that's just contingency, and it's $5 to $10 grand. Just depending on the size of the home and the age of the home, but I would always prefer walk through the house. And then once, again, I've done enough where I can walk through it and I've flipped enough houses and know the material costs and I'd rather go through it with a contractor because it's going to be real numbers, but I can kind of go through it myself and put me in a ballpark. And I've done that before, and we had to replace a $9,000 roof. And my profit went from $18,000 down to $9,000, like that. That was fun. And all the homeowner had to do was file an insurance claim. And they're like, oh, I'm not comfortable with that. And I'm like, it was damaged while you owned it. This is why you pay it. And they're like, I'm not comfortable with that. It cost me $9,000. Wanted to strangle.
Do you change the numbers a little bit if it's like a total gut job, or is there like any red flags?
I would say if you've never flipped a house or only flipped 1 or 2 houses, do not do total gut jobs. You will eat yourself alive. And you just will. I think I told Chris this. We looked at a couple. I was like, your first deal cannot be down to the studs gut. It'll take you twice. 6-month project turns into a year-long project. Lindsay did one. It's just you can't stay on top of it. It's just too much unless you really have your finger on your contractors and really have your finger on the material costs and the process. It just will eat you alive. And if you've never flipped a house, you probably got referred a contractor from mom or something, and it's just not going to work. I promise. Even if I give you my guy who does all mine, it's not going to work because you don't know how to make sure he shows up. Do contractors show up when they're supposed to? No. Almost never. So it's just different. It's a huge. Yours do?
No, always never.
Oh yeah. Okay. I was gonna say, tell me who your guy is. So I have one guy that I found. Good price, slow, but fair, did a good job. I referred him out, and this other guy was like, this guy's awesome, thank you. He put him to work full time. He never does any of my jobs now. And I'm just like, so you can't, I'll refer you people, but it's not going to be my good people. So yeah, so big total guts. Yeah, I mean 45 plus dollars a foot, depending on the size, depending on the age, depending on a lot of stuff. So yeah, do what?
Should cover it.
Should 45, 50 bucks a foot should cover a lot, depending on the size of the house. But if you're going full gut, I'm doing all the electric, new HVAC, new roof, it may not cover it. It depends. Rule of thumb. It's a rule of thumb. Any more questions on flip? That's a good one. I'll tell you right now, and we're about to talk about buy and holds. And as I was doing this, I haven't personally bought a property in over a year. So I haven't analyzed a lot of properties myself recently. And I was depressed doing a couple last night while I was getting my math and everything, or my spreadsheets in place. So buy and hold is very tough right now. Interest rates have doubled in the last 2 years. Prices are still at all-time highs. Buy and holds are tough. Flips you can still find. Because prices are strong, you can still find good equity flips. So what you'll probably find is more flips than buy and hold opportunities, unless you're going straight to consumer and getting deeply discounted properties. Or if you have cash, everything works with cash. So questions on flips? We'll come back if we need to. Okay, analyzing buy and hold property. So it's two types of analysis. Again, this is a different YouTube video where I talk about analyzing buy and hold properties. Go watch it for future reference. Two things we're going to look at. One is the cap rate, which is typically used when you're not utilizing financing. If I'm going to buy it cash, I'm going to look at the cap rate. It's just an ROI, return on my investment. Cash on cash return is typically used when you have financing. If I'm getting a mortgage, really the bank is giving me 80% of this deal. So really all I care about is what is the return on the 20% or the closing cost? What's my return on my cash out of pocket? Because that's the alternative. I could take this 20 grand and invest in this house, or I can go put it in the S&P 500, or I can go do whatever with it and go buy a boat, right? So you have to figure out what's your return on that cash if you're getting financing. That's what you want to look at. Oops. My focus turned off. Can't have you guys reading my text messages. Where's my mouse? Okay. Okay, so we're going to talk about cap rate if we're doing cash deals. We're going to talk about cash on cash if we're doing investments. So here's... Did I skip one? Okay. Cap rate. So again, traditionally this is cash only or not utilizing financing because there's additional and better analysis if you have financing. So cap rate is called the capitalization rate. It's going to be return on the capital that you're putting into it. So a cap rate is going to be the net annual income divided by the total investment. Or another way to say it is rent after expenses, net operating income, NOI, divided by your purchase price plus repairs. How much money do you have in the deal? That is what your cap rate calculation is. So let's use an example. If we have a purchase price of $150,000, repairs of $10,000, make ready or something, gross rents, which is going to be annual, of $16,800, which is $1,400 a month, operating expenses of about $5,500, taxes, insurance, property management, some vacancy, some maintenance, whatever, $5,500. So we're going to be $16,800 minus. So my purchase price minus my repairs, my rents minus my expenses divided by my purchase price plus repairs. So $11,300 divided by 160, 7% cap rate. It's a 7% return. So now that we know that, is that good or bad? I don't know. I haven't looked at the one down the street. I don't know. I might buy this one and every other house in the neighborhood's trading at a 10 cap and I overpaid for it. So I don't know. You have to look at them all. You run comps on the cap too and on the price. So we'll talk about this more in the multifamily and in the commercial slide. But houses are a consumer or a commodity. People buy them and live in them. So when you're comping houses, you'll look at, what up? When you're comping houses, you have to compete against a consumer. So a single family home is worth what someone's willing to pay for it to live in it, right? Multifamily or commercial they're typically only investments. So they trade at whatever money they bring in. So here, when you're running comps, this might be a 7 cap, and that's terrible. I really want it higher, but guess what? Someone else will pay 30 grand higher because they're going to live in it. Because their kids go to school down the street, because they work down the street, because they grew up there, whatever, right? So you can't compete. Sometimes it's tough to compete against consumers. So a cap could be great for multifamily and commercial, and it might be terrible for single family, or vice versa. So you just don't know. That's why this doesn't really tell you anything. You got to look at the market. But this is how you determine a cap rate. So the idea is if I'm looking at this cap rate, I'll find other properties that have sold and I'll run cap rate analysis on those. And if they're all around 7, okay, 7's not bad. If they're all at 8, 9, 10, then my 7's bad. If they're all at 4, 5, 6, we got to jump on this. 7's good, right? So you don't know until you run cap on all of them. Questions on this? I'm going to go into cash on cash. But this is super simple. It's just what's the net operating income? How much does it make after expenses divided by how much money I put into it. It's a little bit more in the commercial and multifamily side, but this is the basic math.
Does that factor in the home future value?
No, it doesn't do. So you can do IRR, internal rate of return. That starts to factor in net present value and future present value. I think that's just an accounting, pencil whip way to calculate. It's how commercial guys calculate returns because they can't make money by doing the normal stuff, so they have to take in future growth into it. And so I don't like doing IRR. Some people do, but not on a residential single family.
So would you say the 7% would be more conservative then, potentially?
Just like for our market?
Yeah.
Well, again, it depends. If I'm buying a 7% cap in Edmond, Oklahoma, or am I buying it in Moore, or am I buying it in? So it completely depends. Okay. 7's going to be, if I'm looking at single family, it really needs to be 8, 9, 10, 11, 12, in my opinion. If you're buying multifamily, there's less risk in a multifamily because there's more diversification because there's more units. So I'll take a less return because it's a little safer, less risky. So maybe I'll take a 7% on a 4-plex or a 16-plex or something like that, or 16 unit, because it's less risky because one tenant moves out, I'm getting zero income for 1, 2, 3 months, right? So it completely depends on what you're calculating and where you're calculating it. You can't look at 7 and say good or bad. It completely depends on all the other factors. But this is how you do the math to find out. Then you do the same math on other properties to find out how it compares. All right, cash on cash return. This one's not more complicated, but you factor a few more things in because basically what I'm looking, so this calculation of the ROI on only the cash you have invested in the deal. So if I put 20% down, what's my return on that 20%? If I'm able to remodel it and get my 20% out and all I have is like closing cost in it, maybe I only have like 3, 4, 5, 10 grand of closing cost in it, what's my return on that 10 grand? So just the cash out of pocket, it's my return on that investment. Because the alternative is I can take that money and go invest in other things. So I need to figure out what is my return on that. This is the calculation we'd use if an investor is getting a mortgage, if they're going to get some sort of debt on the property. So here's a link to this calculator. And I'll just kind of, I think I have it up. So this link takes you to a Google sheet. Where you can't see them because it's too small, but there's 4 different tabs. We're going to talk about each one of these tabs, but when you click the link, it might not pop up on the tab that you're wanting. You usually have to go click on the different tab. When you go to this link, I've locked a bunch of cells. So you want to make sure you go up to File. I don't think it'll be on mine because I'm the owner. Oh yeah, so you'll go up to File and then make a copy. And then you can edit all of it. But don't edit this one or you won't be able to edit it because I lock a bunch of stuff. So make a copy, then you'll have your own copy of all these sheets. You can do whatever you want with them. So we're looking at, so this is the fix and flip sheet that I showed you. This is the buy and hold worksheet. And this is the cash on cash return. Can you kind of read that better? No, Graham? No. Okay. I'll read it for you. Let me see if I can go a little higher. Let's go 250. It only goes up to 200. Okay. So you got your income, your expenses, your cash flow, and your return. These are the 4 kind of quadrants. So we're going to plug in our income. It's rental income, any laundry income if it's multifamily, storage income if it's multifamily, miscellaneous income if there's parking or, I don't know, whatever. Just all the possible types of income for a rental property. If it's a single family, it'll just have rent. So you got rent income, We say it's $1,100 right here. So you got your expenses. These are all the different expenses you might incur as a landlord. So the ones that you're going to always incur are going to be taxes and insurance. There's utilities, but sometimes you won't and sometimes you will. HOA, lawn maintenance if you're covering the cost of lawn. Two things you want to factor in is vacancy and repairs. I promise you will always have vacancy and you will always have repairs. The more you factor in, the harder it is to find a deal that makes any sense at all. And then there's capital expenditures. So this calculator, if anyone knows the Bigger Pockets podcast and website and all that stuff, I kind of ripped this off the Bigger Pockets calculator. I kind of made my own changes, but they would put capital expenditures as like if the heating and air goes out, if the roof needs replaced, if the sewer line needs replaced, like large capital expenses that you need to cover. So they're going to factor in big chunks of each month rent to put away to capital expenditures. They're going to put $110 a month away for vacancy, $110 a month away for repairs. That was when you could buy a $40,000 house that rented for $1,500. Those don't exist anymore. The 2% rules, anyone ever heard of that? That hadn't existed for 15 years, probably longer. The 1% rule doesn't really exist anymore. So these numbers, it's harder and harder and harder to make them pencil. So there's certain things you have to accept as you start to factor these or calculate these out. But I have taxes, insurance, vacancy repairs, property management. If you manage your own, great. And then mortgage or debt service. So it comes out to $1,080. So we're renting it for $1,100. I got $1,080 in expenses. So I'm making $20 a month on this thing. Now this doesn't factor in my debts, my pay down, doesn't factor in my depreciation, doesn't factor into my appreciation. There's a lot of other ways to benefit from a rental property. Cash flow, unfortunately, does not exist anymore, or at least not where I'm looking. So right now anyway. So I got $20 a month cash flow, $238 a year cash flow. So then it goes to my ROI, which is how much money am I putting in the deal, and then it's going to divide my annual cash flow by how much money I have in the deal. This is a 9.5% return on my cash, 9.5. So if I'm cash on cash returns, when I was buying a lot of mine, I wanted it like 14, 15 to 20. I got one at 35%, which is really cool. But you really want to be 10 plus at least, just because, again, you can put it in the S&P 500 and probably do the same thing and not have to take massive expenses once a year. So you really want it to be a little higher than 10. Hard to find though. So again, all the yellow fields are the one that you only edit yellow cells. I put a sign there for you to make it easy. So the payment calculator, we're going to put in purchase price, we're going to put in repair budget if there is one, an ARV, and then your mortgage terms. 7.75 is probably what you'll find in a commercial note right now. Term length is 20. That's probably what you're going to find in a commercial note. If you did 6.75 because you went with a 30-year mortgage, cash flow goes to $145 a month. A little better. 69% return because I got all my cash out. My closing costs will be way higher if I go with a $7,500, maybe even more. So, you just move numbers around to see what your returns come out to. But again, 7.75 on a 20-year is pretty normal commercial debt right now. 6.5, 6.75, is that fair on a 30-year? What would you?
I'd say low sevens.
Okay, so you're still in the sevens even on a traditional 30-year.
Well, on investment property, yeah.
Okay, because you're putting 20% down. Yeah.
About sevens.
Yeah. Yeah. So, okay, so you're 7 to 7.75 even on a 20 or a 30 year, but you can play with it. So you see, it'll calculate your cash on cash return. So this is the kind of payment. This is your P&I only. So you have to factor in your taxes and insurance because this is only factoring principal and interest. So you fill this out, pops that out, and moves it down here for you. You put the rest, gives you your cash flow, your cost, your total investment, your cash on cash return. Make sense? You plug in all the yellow fields, it'll do the math for you. Again, 23%, is that good? I don't know. Look at other ones around it. 23% is good, I'll tell you right now. It's really good. Right now. It was not good 5 years ago. But so this is the calculator for you to plug numbers in and see That's what first thing I do is I look at a rental property, plug that in, plug that in, plug that in, and I come down. It's like, should I even get into it and start analyzing? Should I even spend time on it? This is just a quick way to get the riffraff out, so I can only focus on good properties. What am I doing with my feet? I'm like moving this rug. It's infuriating. Okay. Okay, so that is, again, linked to the calculator. That is our cash on cash return, how we're looking at properties. So again, you analyze 20, 30, 40, 50 of them. You'll start to know what percentages are good. And you'll start to know, even before you plug into the analysis, you'll start to know, just by looking at the raw data, if it's worth plugging into the analysis. Right, yeah, exactly. Quacks like a duck. What is that? Okay, so has anyone heard buy homes with no money down, no money out of pocket? Real popular the last 10 years. The BRRRR method. Who's heard of the BRRRR method? Okay, I'm going to break it down. It's super simple. And I'll just, as a disclaimer, BRRRR methods are great as a way to get into a property and kind of build equity in and be very little out of pocket. Your cash flow is likely going to be poorer, less than, if I just went and put 20% down and bought maybe a performing asset. So, great way to get into money or get into a property with low or no money, but there's still just a lot to it. Remodel it to increase value of the home, rent it to start generating cash flow, refinance it to pull cash out and get long-term financing terms, and then repeat using the cash I received from the refinance. So it's how I was able to get started with a little bit of money down and kind of accumulate a little bit of money. I had 25, 30 grand. I used it as a down payment. The bank gave me remodel costs. I remodeled it with the bank's money. And then when it's done, the value's up, someone's renting it. I go to a different bank and I refinance it and get my money out that I gave them originally. Does that make sense? I put permanent financing. So I can put it on a 30-year lower fixed rate, or I can just refinance. Some banks will just give you your equity back when the project's done and they inspect it. So there's different banks do different things, but that's the concept. Put my own money into it, remodel it with the bank's money, refinance it when it's done. And then I get my money out. So now I have a house that costs me $0 to $1,000, $2,000, $3,000, $4,000, $5,000 maybe out of pocket. I've got a house with 20% equity, cost me a couple $1,000s. It's a great model if the house is renovated properly and managed properly and there's not a bunch of crap go wrong with it. But as we know, that's not how real estate works. So this is the model right here. So the this is the calculation to determine what do I need to buy it at for the BRRRR model to work. So I'm going to figure out my ARV, comp it out. Again, don't comp it out as if it's a top of market property, but then do rental updates, right? You can't comp it against a bunch of stuff that has granite and marble and whatever and solid surface floors, and then you put Formica and carpet in yours. It's not the same. Maybe the bank will think it's the same, but that's how you get upside down on a property. So ARV based on your repairs, you're going to take 80% of the ARV, so 20% off the top, because the bank's only going to give you an 80% loan. Some banks might give you 85 if you're an established borrower or if you have a ton of money in your bank account. But 80% is normally what you're going to get in a loan, so you're going to take that 20% off. Then from the 80%, we're going to back out our closing costs, back out our renovation costs, and that's what we can buy it at to be $0 out of pocket. So what that looks like is I'm buying a rental that's worth $175 after my repairs. My loan amount is going to be $140. That's the max a bank will give me to buy the home in its condition with the repairs. So I'm going to back out closing costs. If I'm doing a commercial loan, you're going to have like a point maybe plus some appraisal fee, $2,500 to $3,500 on a commercial loan. Renovation costs, $25 grand. So the most I can pay for this property is $112,500 if I want to be $0 out of pocket. And then every dollar above that, oh, I got another slide. But let's say, again, I need to be $112,500 to be $0 out of pocket. I can't get it for $112,500 because it's just not how it works. I can get it for $120,000 though, which means I got $7,500 in the deal. Make sense? So that I would take that $7,500 and figure out what my cash on cash return is, because that's the money it cost me. I bought a house for $7,500. Does that make sense? How we got there? So I have bought houses where the purchase price was less than 112, where I actually made money to buy the house and left money in the deal. Or if I had another project going on, which I always did, and needed more money, I would take that money and put it into a different project. So it can be done for relatively little amount of money. Problem I see with this is if you're doing it too fast or too often, like I did, this home buying machine is a cash guzzling machine. It takes money to buy houses. Now it's like, well, I thought it was no money out. Well, when I'm buying them, I'm giving every bank $3,000. Every remodel budget turns from 25 into 35. And so it just gobbles money up, cash up. Then you have to manage it, and toilets break. And in 2019, I replaced 7 sewer lines. Spent $35,000. I put a plumber's kit through college.
You got a call from your plumber that year?
No, I didn't. Change plumbers. Because I called and they didn't answer, and I was like, bro, that's not how this works. I had that huge ice storm that came through in 2021. I had like 9 or 10 grand in just tree removal on 20 something properties. Every property had a tree, and every tree got destroyed. And so it's just like stuff happens. And so if you go too fast, buy too much, all your cash is gobbled up by just the acquisition cost, the holding cost. And then when stuff goes wrong, you got no money to cover it then. You got to keep reserves as you pile properties on. So this is a great way to buy properties with little or no money down, but it still costs money to own property. The biggest myth the internet ever told was that you can buy 6 houses and quit your job, or whatever the internet's telling people nowadays. Owning rentals costs money until you're about 5 or 10 years out. When you're 5 or 10 years out, then they can start becoming a cash flowing asset. But the first 5 years or so you're owning rentals, they're probably costing money unless you got them at a significantly discounted rate. Now, they're not bad. I'm glad I own all of them, and in 5 and 10 years, I'll be really glad I own them all. But again, I want to make sure I dispel the internet's rumors that you can just buy 6 houses and quit your job. That's not how it works. So this is how you buy houses with very little cash. Now, if you're doing it once a year, a couple times a year, or you're a high earner and you can float all the cash that you're needing to put into it, that's great. But just because I'm only $7,500 in this deal, it costs more than $7,500 to hold it and run it and manage it. Does the Burr method, I think that's the Burr method, make sense? It's a great way to get into a property with built-in equity, little cash out of pocket. Cash flow is probably going to be boo-boo for the first couple years, especially if rates double, just fun stuff of being in the market. So the better you buy it up front, the better the deal is. I got 26 properties. I've sold off 8 of them. No, sold off 11 of them so far because the debt was coming due on a commercial loan. Every 3 to 5 years it resets. Debt was coming due. The new interest rate, I would be losing hundreds of dollars a month on the property. So it's just like, got to sell them. So they were okay for 4 or 5 years, and then they're not okay, and you sell them. So it's just an analysis, and it's an investment. Luckily, I bought them right, had good equity, made money on the sale, and all that stuff. But they would have been losing money as a rental. So you just got to look at it. Questions on the Burr? It's Burr outside. Polar vortex method. Okay. Analyzing multifamily / commercial, because they're kind of the same thing. So, again, I talked about this a little bit earlier. Residential versus multifamily valuation. As a single family residential home, you always have to compete against a consumer. So when I'm comping a single family house, I want to run the numbers to see what the return's going to be, but just because the return doesn't equal a valuation. Because other comps in the area could be selling for higher, which would give it a lower return, so it's actually worth more than what my return says. Does that make sense? Because the homeowner is going to want to live in it. So when I'm comping multifamily or commercial, it's traditionally, it's driven by investors. So whatever the return is, does correlate with the value. Does that make sense? I don't know if I'm explaining that correctly or not. The return with commercial and multifamily, the return equals value. With a single family, return on a $500,000 Edmond home is going to be terrible, but someone's still going to pay $500,000 because it's what other homes are selling for. So understand the difference in valuation of multifamily and commercial. Even owner-occupants buying commercial property, they have to factor it against what rent is somewhere else, right? So it's almost entirely strictly investor based. So multifamily and commercial traditionally trade off cap rates. That's all it is. What is the return of this property? That's what I'm going to pay for it. And then I compare it against other returns. Not so much the last 2 or 3 years, but the previous 5 to 8 years, multifamily was smoking hot, especially in Oklahoma City because it was relatively cheap nationally. So you used to be able to buy a multifamily property that was like a 10 cap. Well, every person from California to New York realized you can buy a $300,000 eightplex, and so they started dumping money here. Well, now multifamilies trade at like 4 caps because it got so hot. So the return is completely based on the market. If I say this property is an 8 cap, is that good? I don't know. What are the other ones trading at? 8 might be great, 8 might be terrible. So it's completely based on the market, the location, all that stuff. You can't look at one property and know if it's a good return or not. So unless some people buy commercial just to park money and they're okay getting a 4% return because of the tax benefits and that kind of stuff. Most commercial real estate is driven by tax, avoidance. Tax deferral. Most of it, people are not looking for returns. They're looking to park money, most people. So that's why they trade off cap rates, but you're competing against people's lack of need to get a return. So any investment property is only worth what it brings in rent. It's only worth what it makes. So we're going to go back to cap rate. So cap rate is the net annual income, net operating income divided by the total investment. So rent after expenses divided by purchase price plus repairs. So again, we're going to use just this example of a property that makes $36,000 a year in rent. It costs about $7,500 a year to maintain. It costs us $375,000 to buy, $10,000 to make ready or do whatever. $100, the net operating income divided by my all-in of $385, 7.4% cap rate. Is that good or bad? We don't know. That's right. Good job. We don't know. We have to look around. But this is how that's why if you're looking on LoopNet or Crexi or even multifamily on the MLS, people are going to reference cap rate, listed at an X% cap. When they're buying, an investor's going to say, I'll buy anything that's a 9% cap or higher. Then you got to go figure out, okay, how do we get there? Can we raise rents? Can we get it for lower? You got to figure out. I have another slide where we kind of play with the numbers. But everything's based on a cap. They're going to sell it at a certain cap because they know they're going to have to take that money and go buy something at that return. Buyers are looking for certain caps. They market it at certain caps. It all comes around a cap rate, and this is how we determine it. Make sense? Problem is figuring out these numbers when you're looking to buy something. How accurate is it and all that stuff. So do your own, because I've looked at proformas from people, and their insurance will be like $50 a month. It's like, you're not paying $50 a month insurance because I'm going to have to go get $150 per unit per month. And so do your own analysis based on what you're familiar with. So this is the math. So let's see here.
What insurance numbers do you have a general insurance number you use for multifamily or commercial or anything?
No, I know what mine are on my properties, and I kind of use those, but most of my rentals are C-class properties, lower values, so the ratios will be different if you're buying so the best thing I can say is get with a commercial guy, and I wouldn't get an estimate until you're like look under contract, but talk to a commercial guy and say, I'm looking to buy a rental at X, what's a landlord policy, and he can ballpark you some stuff, most likely. Okay, so this looks like there's a lot going on here. So 3 different bullet points, so just stick with me on the top one. So when doing a cap rate, there's 3 variables. There's the price, the income, and the percent. So if we know 2 of them, we can solve for the third one, right? We're going back to 2nd grade, 3rd grade math here. So you got to solve for X. So if we know the income and the average cap rate of an area, I can solve for what I think it's worth. So if I know it makes $28,000 a year after expenses, and my guy only will buy an 8 cap, then I can figure, okay, Mr. Investor, you have to buy this at $356. Does that make sense? That's how we determine that. If we know the income and the list price, I can solve for what the cap rate is. Hey Brett, I'm looking at this property. What's the return? What's the cap rate on this? I know it makes $28.5 after expenses and it's listed at $385. So I know the cap rate's 7.4%. Is that good or bad, Mr. Investor? I need this, okay? If we know the list price and the desired cap rate, we can solve for what the income should be. So we can divide the list price of $385 divided by the cap rate that he desires or she desires, and we can assume, we can say, if you need a 7.4 cap, Mr. or Mrs. Investor, we need to make sure it rents for $28.5 after expenses. Make sense? You can move them around and solve for X. Graham and I, this is kind of what prompted this whole class. Graham and I were talking about his multifamily apartment complex. What if we don't know anything? His was completely gutted out 30 unit? 32 unit. Doesn't have any rent rolls. Doesn't have any rent history. Doesn't have any value because it's gutted out. We don't know what it's going to cost to, we're just like, how do we figure out what this thing's worth? So we're going to run rent comps to determine what the rent could be after remodel. Then we're going to run cap rate to see what's normal in the area by finding other properties that have sold and figuring out what cap rates they sold at. Then we're going to divide the rent comps by the comparable cap rates. We're going to figure out what the value should be. Then we know what the value should be. Then we back out what it's going to cost to get it there. Right? So based on this, the value should be $1 million. It's going to cost us $200,000 to get it there. Okay, now the value is $800,000 to put $200 in it to end up with an X% cap. Does that make sense? So sometimes you don't know, you got to run comps to find out what rents should be. It's 32 one-bedroom units. Okay, what's a one-bedroom unit in apartment complexes rent for? $750 a month. Okay, that equals X dollars a year. We can assume 15 or 20% maintenance and vacancy. So back that off to come up with your NOI. Divide it by the cap rate that's normal down there, 10, 8, 9, 10%. What do they think they're buying it at?
1.8, the biggest variable that I have been getting pushback on is that 20 to 25% vacancy.
They want higher?
50 is the numbers that
a lot of buyers
are using. They said because it's
the remodel time,
and
it's going to take them. Yeah.
Is why
so
that number is.
They're factoring year one expenses. So that's why. So it's going to take them a year to remodel it, or maybe 8 months to remodel it. And they're not going to it's not going to generate revenue for 8 to 12 months. So that's why they're factoring. But then they're going to own it after that and make vacancy shouldn't be beyond 20. Vacancy maintenance shouldn't be, especially if you just remodel it all, shouldn't be beyond 25%. But again, that's that investor. That's kind of what you have to remember too is when you run these caps, it's like, is that good or not? I don't know. What's the investor want? Are they just need to park money and I'm okay with a 4, 5, 6 cap? Or am I looking for something juicy because I'm on my last $50,000? I need to do something with it, right? So what do they want? What's their investing goals? There's a million ways to skin a cat. We're trying to get cash flow. We're trying to just get some tax benefits. We're trying to flip it in a year or two. What are we trying to do? So when you're comparing all these are going to give you the numbers so that you can have these conversations. What's our goal? Is this good? Is this suffice? Is this what we want as an investor? And so if you're meeting with an investor and they don't know what kind of returns they're looking for, I just had a friend message me yesterday. We were talking, wants to start investing. So we're going to get together and be like, what are you trying to accomplish? You want, have you been watching the internet too much and you think you're going to get $500 a month off this burr that you're looking for? Were you going to buy 60% below market value? Okay, well, this is going to be short run. So you have to, if your investor doesn't know what they're looking for in their investment strategy, try to educate them or just be like, now's not a great time for a new guy to get into the market unless you're going to go start pounding pavement looking for direct to seller deals. You're not going to find anything on the market unless you're your expectations are really set with what you're going to find. And the last slide is the investor packet. It's the link that I showed you guys. You can go look at it. Okay, we got started a little late and we ran a little long like normal. Any questions? Analysis, finding, deals, math, flipping.
On your flips, where are you usually sourcing like materials, subcontractors, GCs, etc.?
subcontractors, don't go to Google, don't go to mom or dad. You got to find people that work on investment deals. There are, like a plumber. I know a plumber who's a really good plumber. He's like, I won't work with builders and I won't work with investors because investors are going to beat you up constantly. And there are some guys who will only work with him because they like the work. I'm going to make less money, but I know every week I'm going to have a job with this guy. So don't go to Google because anyone who spends money on advertising is going to upcharge you because they're spending money on advertising. If you hear a plumbing radio on the radio, they're ripping your freaking head off.
Consumer plumbing.
Yeah. They go after old ladies that'll pay $5,000 for a water tank. So, it's fine if you can get it. So referrals is the best way to find them. If you can find a GC that has the subs, that's good. Normally they source subs, but you're paying a little extra for the GC.
GC your own rental flips?
I do. I have a guy that has subs, but I don't pay him like a GC. I still have to manage him. But he has the people, so I don't have to go find the floor guy and the sheetrock guy and the painter. He has those guys, and then he doesn't do certain things, and I got to go find the other things. But I mean, depending on what you're doing, if you're doing a lot of flips, maybe you can buy stuff in bulk. But if you're flipping 1-2 houses a year, go to Lowe's, go to Home Depot, go to, there's certain places. Shop around. Amazon, you can get a lot of stuff pretty cheap on Amazon now, fixtures and stuff like that, flooring even, so stuff like that. But source them around. I got with a designer a couple years ago and paid her $1,500 to completely design this flip I was doing. Everything from the paint colors to the floor type to every door handle and every tile and everything. Designed all of it so it all matches. And then every flip I've done since then, I've just copy and pasted it, and they gave me a binder with all of it. Links to click on to order it, everything. It was freaking sweet. It's a really good idea. And so I give it to my contractor. So everyone, you'll know if it's one of my flips because it's got the same color cabinets, same color walls, same flooring, same everything. They discontinued my flooring. I'm doing one now. I got to find new flooring. It's more expensive, and I don't like it as much. And so, but if you find a good model, you just stamp it out. But if you're doing a couple, go to your Lowe's and your Builder's Warehouse, and yeah. If you're flipping a couple houses a month, maybe you start buying stuff in bulk from wholesalers, but from material wholesalers. But no.
I was gonna share. We found a good website, rentometer.com.
Yeah.
You can do it 5 times.
Yeah, and they make you pay for it.
$99 a year, but if you plug in the address and the size of the house and what you want for rent, and then it kind of gives you a gauge on if you're good for your investor or whatever. But rentometer.com is
Yeah, the cool thing about Rent-A-Meter is you can click on it. It takes you back to the old Zillow link, or it used to anyway, versus if you're running rent comps on Zillow, you don't know what was for rent a month ago, right? So you can just see what's currently for rent, which doesn't really tell the whole picture. So Rent-A-Meter will take you to the rent pictures of the things that rented a month ago, and you can see photos, and it's really good. But yeah, it costs money. But if you own rentals, most property managers have software like that, and yeah, Rent-A-Meter's good. You just keep putting in a new email, though. Get 5 more.
Oh, that's true.
That's what I did. I already have like 6 emails for some reason, so I just put it in. Good question. Good comment. What else? All right, guys.